Jane, how are you today?
I'm good. Thank you very much for having me.
All right, terrific. So listen, why don't we get started? And firstly, welcome everyone to this podcast on real estate investing. And is it a good inflation hedge, fact or fiction, or myth or fact? And the panel will give us their thoughts on the answer to that key question. But the fact is out there that we're in an inflationary period. All you have to do is read the newspapers, see what the Fed's doing, see what the CPI is doing, fill up your gas in your gas tank. The cost of filling up your tank is 2x what it was at the pandemic lows. So inflation is upon us. And the question is, from an investment perspective, what the heck do we do about it? So hopefully after this session, you'll have a better insight on that question. So if you'd be kind enough, go to the next slide, please. So we couldn't have a presentation without a legal disclaimer, and this is our legal disclaimer. But in a nutshell, if we're giving people education, and this is an education session, we're pretty much allowed to share our insights and opinions in an uncensored, open way. Once we delve or cross the line into financial advice, the rules change. It's regulated. But the fact that we're sticking with education gives us more freedom to share keen insights, and which is our intention for this call. All right, so go to the next slide, please. If you've been on a previous podcast, this will look familiar. And we intentionally repeat this because we think it's so fundamental to wealth management. And real estate is a portion of many people's investment efforts. So when we think of private wealth, we think of a four-legged stool, which is the graph on the left-hand side. So what is your private wealth? It's your net worth, which includes your investable assets and your non-investable assets. And for many people, their largest non-investable asset is their primary residence. That it also includes your investable assets. That could be your 401k, your brokerage accounts, or whatever you're doing with your investable assets. And all those things should and being embellished and encompassed by trust and estate planning, tax planning. And I'm a former CPA, but I can promise you, it doesn't take magic to fill out a tax return. It definitely takes expertise and science to do tax planning. And done right, tax planning can dramatically reduce your tax burden. And if you do it before the taxable event, you save money. You do it after your taxable event, your degrees of freedom are limited. There's not much you can do about it. So we really emphasize tax planning as a feature of our private wealth program. And lastly, it's insurance. And in the insurance space, there's many different types of insurance, but we like, for investment purposes, something called private placement life insurance. And in a nutshell, it gives you the ability to have another tax-deferred vehicle in addition to your Roth or your 401k, your IRAs. So it's another way to have investable assets that don't have a tax burden put on them. So that's what we do. So let's go to the next slide. Okay, pure and simple, your investment allocations, how you crack the case of optimizing your investments for wealth management purposes. Things like stock selection, I call it the Jim Cramer phenomenon of the hot stock of the day, et cetera. Yeah, that's fun, it's entertaining, but it doesn't create wealth. It's a waste of time. Now, if you quickly look at the slide on the right, this shows you what I call the efficient frontier, where our recommended allocation has a higher return than a pure equity portfolio, less risk than 100% fixed income portfolio. So you want to be in that top left-hand quartile where you have the highest return with the least risk. So those are solutions that we advocate. It's a solution that I deployed for the partners of McKinsey and Company when I ran the global private wealth practice for McKinsey. And it's a service that we offer to this day because we believe in it so strongly. And we find that most people don't get this right. So if it's something you'd like to be exposed to, we do this as, frankly, as a way to give back because we believe in it so strongly. So if it's something that you'd like to partake in, reach out to us and we'll schedule a time to go through this with you. Budget about an hour, and I promise you, you'll leave much more empowered than when you started. Okay, so go to the next slide, please. So good. Now we get to the fun part of the session. So I'm going to briefly introduce Jane Wu and Lee Kosmac, and then let them take us through the rest of the presentation. So I'll let Jane and Lee give you their background on their own, but just so everyone knows, Jane Wu is in the real estate development business. She's the CEO and founder of a firm called Panorama, and she's had an amazing track record in the space. And I think what she's doing will definitely be relatable and exciting to everyone here. So Jane, would you be kind enough to share with the audience a little bit about your background?
Sure. Thank you, Mark. And nice meeting everyone virtually. Jane Wu, I'm the CEO and founder for Panorama Holdings. Panorama Holdings is a real estate development and investment firm. Started in 2012, and we are headquartered in Charlotte. Mainly focus on the multifamily sector, but we also do hotel and office. And so far, we have about $580 million under management and have about $1.5 billion in our pipeline. And the locations we are, the markets we're focused on mostly in the Sunbelt city. We have projects in Charlotte, North Carolina, and we have project in Tennessee, Nashville, Tennessee, and we have project in South Carolina, including Charleston, including Columbia, and we have project in Texas, and we also are looking into Raleigh, and we have a project in Denver as well. And we also have project in New York City, which is outside of the Sunbelt city. Yeah. And we do mostly development, but when time is right, we will do acquisition as well.
Well, with the Fed raising rates and the cost of owning real estate becoming more challenging, I suspect some of these quote unquote over-levered investors slash owners are going to find that they can't cover their liability, and there are probably going to be some attractive assets that you'll be able to swoop in and acquire at an attractive level. At least I hope you will.
Yeah, we have already seen a lot of changes in the past 2 months. It was a very interesting 2 months to be through, and also, there will be a lot of potential opportunity come up. Yes.
Well, very nice. The world is your oyster right now, and we have Lee Kosmac, and Lee's also an entrepreneur in residence for Bridgepoint Capital. She's spent a good portion of her career in the real estate space, so I will let Lee introduce herself, and then frankly, she'll host the rest of this podcast. So Lee, please share with us your background and what you think of what's happening out there.
Thank you. Thanks, Mark, Nadia, Jerry, and Jane for all your effort in helping put this podcast together. I have more than 25 years of direct experience in commercial real estate as a broker, as an investor, and as an executive. I started my career as a commercial broker in New Jersey, moved my book of business to New York City, and I've done deals across the US, in South America and Europe, because my clients took me there. So either my clients were tenants or investors, and I was just hired to help them with their portfolios. I did spend 5 years as chief of staff to the CEO of a global real estate company that's headquartered in New York. And just a bit about me as a person. Curiosity is my go-to learning style and my driver. And I consider questions to be the most valuable tool I have in my influential toolkit. So just a little about me. And I would encourage you all to ask questions if there's anything that Jane or I mention, any concepts that you don't understand, or any terms that sound confusing. So today I'm just going to share with you some of the knowledge and experience around the topic of investing in real estate in private markets. Since we only have an hour, this is going to be a high level kind of setting the context for this asset class. And then we'll go into some headline review to see how that kind of fits with the different strategies. And then Jane will be giving us some insight as to how she thinks about investing and what kind of returns she's expecting given the current environment. Next slide, please. Okay, so our focus today is going to be on private markets. It is not going to be covering REITs or ETF REITs, which are in the public sector. If you are interested in these topics, just let Mark and Nadia know. We can certainly build a session around those topics. And the other topic it will not cover is something that Mark mentioned, and that is tax strategies, tax deferral strategies, and other kinds of tax strategies that I strongly recommend anyone who invests in real estate to have a tax advisor, because you can really get hammered if you don't know what the impact of your real estate returns will be. I don't know if Drew Swenson is on this call, on this podcast, but he's from a company called FTS. And I know he specializes in tax deferral strategies, 1031 exchanges, and that kind of thing. If you're interested in reaching out to him, just let Mark or Nadia know. So when I mention real estate, what's the first thing that comes to mind? Anybody want to put their hand up and answer? Alice, I see you on the call.
Yes, ma'am.
When I say real estate, what's the first thing that comes to your mind?
Buildings, tall buildings.
Tall buildings.
$100 million.
Wow. That's not the answer I expected. Most of the time when people say I'm in real estate, they want to know how many homes you've sold. So the reason for that is we all occupy real estate, whether you rent an apartment, whether you live in a home, whether you own the home, or whether it's a rental or mortgage. We all occupy space in an office, even if your office is at home. So real estate is very personal to all of us. But what we want to cover today are some different ways to think about real estate and expand the opportunities that might be available. Not knowing how many people on the call are already investors in real estate, some of this might sound kind of elementary to you, but the goal here is to kind of set the context. So today we're going to talk about strategies in real estate, sectors in real estate, and the economic drivers. A lot of people confuse strategies and sectors. So hopefully we'll clarify that. So next slide, please. So these are at a high level, some real estate strategies or approaches you might want to consider as you think about where you might want to invest in real estate based on the kind of returns and the kind of risks and the kind of opportunities that are presented. So the first strategy you see there is called a core strategy. This is typically an asset that's of high quality in a strong market, a desirable location with low vacancy, whether it's an office or a multifamily. And usually investors who have a low appetite for risk are the investors who like this strategy, because it's characterized by lower returns, but really strong, stable cash flow. And it's also ideal for thinking about wealth preservation. It's typically a buy and hold strategy. And there's usually a relatively low effort to maintain an asset. For example, a core strategy might include a modern apartment building in a populous coastal city, and it has a very high occupancy rate. In real estate investing, funds usually have a core strategy that has an open-ended fund. In other words, there's no set time to close the fund. And if you have an investment in apartment building and you get regular cash flow that's high quality, that you get that monthly distribution. You get a monthly distribution, it's stable, you can count on it. And when you exit or when the fund closes, you get an appreciated value. The return may not be as high, but you'll benefit from the cash flow. These types of strategies usually benefit earlier in the economic cycle rather than later. They are somewhat of a good stable inflation hedge. Core Plus is very similar to core strategies. It's just a situation where the asset needs to be enhanced slightly, where there's a little more exposure to lease expirations, requires minor renovations or some tweaking when it comes to positioning. An example might be an office building that benefits from some cosmetic improvements such as new carpeting or lighting, or maybe a manufacturing facility that could use a HVAC upgrade, that kind of thing. Then we move on to value add. These investments, you're looking for higher returns because you're targeting properties that require more intense effort, such as a major renovation or major repositioning. Typically, these assets are held for longer periods of time because it takes time to make the renovation. And then you also have to consider that property managers and general contractors are important to executing on this strategy. Examples of this kind of strategy might be a rundown medical clinic with equipment that's outdated, or a shabby hotel with a modestly low vacancy rate. And the value add then moves up on the risk profile. And then we have opportunistic. These are assets that require substantial investment because they need a high degree of renovation. The vacancy rates are really high, or there's a shifting in supply and demand dynamics, such as what we see happening in some of the larger cities, where the impact of hybrid work from home, work from office, are forcing a lot of companies to rethink how much real estate they really need. And in that case, there's a really significant shift in supply and demand, not just for office space, but also for residential space, which is now the place where office work will be done. An example might be converting an office to residential or retail, or converting a vacant mall to a data center. These are examples of opportunistic strategy. Then we move on to distressed. And distressed and debt are usually lumped together, and they focus on assets that target properties or mortgages where the current ownership is either in default or near default, or if lenders can't sell foreclosed properties. The idea here would be to turn the asset around. It carries a very high risk profile, and certainly returns are expected to be high as well. More opportunities exist, as Mark mentioned earlier, for distressed strategies during economic recessions or downturns. So now is the time to be thinking about, if you're going to get into investing, even though it's a higher risk profile, distressed properties are an interesting area to look at for investing. Next slide, please. So those were real estate strategies. They're often confused with real estate sectors. There are only three basic sectors: residential, commercial, and land. Residential, almost everyone knows what residential is. Mixed use. I'll give you an example in New York City. You have office, you have street retail, and you have residential in some cases. And the unique thing in New York City is that you might have 3 or 4 owners. One owner would own the ground, another owner would own the retail, a third owner would own office, and a final owner would own residential. So it becomes very complex, especially when you're looking to do a deal in a building like that, and you want to know what kind of lending is involved. So it can be very complicated. In commercial, again, hospitality, that's an area that's, it sounds like a sweet spot for Jane. Healthcare, the facilities that house not just hospitals, but all kinds of care facilities. Self-storage or flex space, as it's known in New Jersey. Manufacturing, and I think there's one I can't see. Logistics. Logistics is very interesting because of the supply chain issues that we're faced with, and the big box distribution facilities. There's also data center facilities and cell towers as separate commercial sectors that have a lot of interest, that carry a lot of interest. And then raw land and agricultural land. And Mark, you made a comment earlier about raw land. You want to share that with us?
Well, before we started, we were having a chit chat amongst a few of us about these different sectors. And I mentioned to Lee, maybe it would be nice to personalize the land sector, because I believe Bill Gates is the largest owner of land in America. And also, I know Ted Turner is a very large landowner as well, but people with a lot of wealth see value in land. And it's an interesting topic. It's really not something we want to drill into too detailed for today's call, but there's lots and lots of, I'll just say, tax strategies around land that people can do to reduce tax burden and generate, I'll just say, tax credits and things to quote unquote reduce their tax burden. But there's a lot of innovative things happening there. I can share with you that much.
Great, thank you. Now, let's see. I see some questions in the chat. James, are there any questions, or Nadia, are there any questions in the chat that we should answer?
Well, I think there are a couple of questions from John. I don't know if we want to address them later or right now, but basically the first question is about the concern around New York City market, especially post-COVID. And Jen mentioned she would love to talk about it a little later. Okay,
great. That will tie in with some of the interesting things Jane is looking at in New York City.
Yeah.
Okay, go ahead, Jane.
Sure, yeah, thank you. Yeah, John, I saw your question in the chat box and absolutely agree with you. We actually, New York City is not our key focus. And we're only in New York City when the very unique opportunity comes, okay? So as I just shared, our focus is Sunbelt cities. We follow jobs, we follow money, and those are the fundamental part, and then we watch our cost. So New York City was never was a key focus for our firm. But the New York City project we got were during the pandemic, as everything you were mentioning, there are actually a lot of distressed assets came to the market. So I will give you examples. So especially in the hospitality market. So last year we acquired a hotel in the World Trade Center in the financial district. And when we acquired that hotel had about 30% occupancy and $89 ADR. So it was definitely qualified as Lee shared, it was a distressed asset. But we look at the fundamental for that hotel, and it was in a really great location, and there will be demand when people return to the office. And we look at the cost to it. So our acquisition cost for that asset was about 40% below the market. And we ran out all of our financials, everything, and we had that, we source our financing, everything. Then now we already, then we bought that hotel, closed the deal in August. Now the hotel is already 93% occupancy, and our ADR is $220. So that's the type of asset we will go into New York City if we have opportunity like that. In a matter of fact, we're actually acquire another hotel in New York City, which is same thing, hotel, but we are buying this hotel. It's actually already a 99% occupancy, $230 and $230 ADR. But we are buying it at a distressed asset price, even though it's not distressed at all. It's because of the owner has some other financial challenging with some other projects that they need a quick closing, all of that. So we came in and we know the market and we know we can operate it well. So those are the opportunity we see, and there are still some of those like that. And just as you mentioned, everything there, New York City has its own challenge right now, but there are still some good asset can be acquired. So hope that answers your question.
Great. Thanks, Jane.
Sure, thank you, Lee. All right, okay.
Next slide. So, with all the volatility and uncertainty and the geopolitical instability, private market investors always move to focus on real assets because they're perceived to be stable and offer protection. And many real estate investors look to real estate to protect their returns against decreasing purchase power of money, which is inflation. And theoretically, this holds up because, it's very difficult to change homes or change offices. It's not like toothpaste where you can change a brand quickly or you can downsize quickly. And one of the things you need to consider is that there are two kinds of drivers, high level, systemic drivers, which affect all areas of real estate. Interest rates, for sure. Inflation as well. But then you have the idiosyncratic drivers that are really dependent on the specific type of sector, the specific type of geography, and the specifics around the financing of the building. And Jane just gave you a perfect example of how she was able to surface an opportunity in New York City because of some idiosyncratic drivers. So in spite of the increasing interest rates and inflation, and I'm not sure, how much is left
I'm gonna wipe out the book. Open up.
in that asset in New York City, but that would be the only place that I would see interest rates or inflation having a little bit of an effect. But it sounds like she's really set up to go because she's done the right kind of diligence. So the bottom line here is if you deploy strong investment fundamentals, that should be the foundation for real estate investing. And inflation hedging is just really an ancillary benefit. So is real estate a good inflation hedge? The answer is it depends. Next slide. So there are three high-level factors that are relevant to real estate investing. You invest where supply is low and demand is high. You anticipate where public and private capital will flow. Like Jane said, you follow the money. And then in certain circumstances, you can acquire property below local replacement cost. Let me just give you some examples of these factors. Next slide. So last week in the Wall Street Journal, I pulled some of the headlines that are related to real estate. So the first one, empty Wall Street offices to be revived as apartments. This is Silverstein Property. He's the kind of person that's very optimistic. He's a longtime investor and a big landlord in New York City. What he's doing here, he's repurposing an office building because the conversion costs to repurpose are less than to replace the asset. And at the same time, demand is shifting. So he's anticipating or assuming there will be less need for office space in New York. So he's converting one of his buildings to 571 apartments. So does anybody have any idea what kind of strategy this might be? Nobody? Charles, are you on?
Yeah, I'm on.
What do you think? What kind of strategy would this be? Would this be a core strategy?
It sounds like a pretty core strategy. Sounds like a lot of development needs to be done.
Okay. Okay, so in the case where a lot of development needs to be done, we would probably categorize this closer to opportunistic because it does carry some risk, because he's going to have to do some construction and supplies and inflation might come into play here. So it is opportunistic. He's taking a higher risk that he will make money down the road when the building is converted. Moving on to the next headline, New York City developer launches life science venture. This developer by the name of Taconic believes that the city has a lot of talent and there's a lot of money out there for lab space, but there's not enough real estate. So this is a situation where supply is low and demand is high based on Taconic's assumptions. That's the strategy that, or the general investing principle that's at work here. The third one, Intel delays groundbreaking ceremony for Ohio plant. This is a really good example of the flow of private and public capital and the impact on job growth and the housing market. What you see here is probably a core or core plus or value add or combination of the three, because of the housing that will be tied to the new job growth and the building of this plant. So the plant will probably take 2.5 years to come online, but during that time period, there will be a lot of construction and a lot of need for housing, temporary, and then moving to permanent housing. And then finally, Netflix lays off about 3% of workforce in new round of cuts. The key here is, where are those layoffs going to occur? Because that will have a definite impact on supply and demand as well. So here again, you're anticipating, in this case, the negative flow of capital in the case where layoffs may affect housing. And if Netflix is laying off, and if we are about to move into a recessionary period, there may be further layoffs. So anticipating these flows is all part of real estate investing. And just remember, when you run financial models and you make assumptions, assumptions are guesses, just like anticipating the flow of funds. So it's a situation where real estate investing also involves understanding some of the economics, both national and local. Okay, let's break now from the slides and go back to can we go? No, let's go back to just the conversation. Mark, can you help here? Just start us out where everybody's on the grid here.
Okay, let me add a couple data points to stimulate the discussion. And again, this is intended to be a conversation, and we certainly want to hear both Lee and Jane's perspective on things, much more than my perspective, because I'm not the real estate person. But I just want to point out there that, yes, we're in a very high inflationary period. Everyone reads the headlines. I think the last CPI number that I saw, the CPI was 8.4%, which was a 40-year high. By the way, the S&P 500, if it dips below 20% decline from the peak to its trough, that's considered a bear market. The S&P is down year to date about 21%, so it's a bear market. The Goldman Sachs Commodity Index, which is one of the tools that people use to, I'll just say, address inflation, that index to date, year to date, is up to about 26%. So stocks are down 21, Goldman Sachs Commodity Index up 21, 26, and you also have the 10-year Treasury, which is one benchmark of fixed income. That bond is down 11% for the year. So the old standard portfolio is 60% equity, it's 40% fixed income. That blew up this year. It didn't work. And I hate to say this, but at the end of June, people are going to open up their 401k and their IRA statements for Q2, and they're going to have a heart attack because it didn't work. And that's part of the reason we're trying to tell people, hey, wake up. 60-40 isn't the only choice out there. There's other things that are more appropriate to do to deal with inflation. So that's just a reminder that real estate done wisely and correctly is a solution. And I'll just say one final thing about inflation hedging with real estate. The way I think of it, your rental cash flows are variable. That means they can go up or down, but if you're in an inflationary period and you have a market with strong demand, they're not going down. I have my son, his girlfriend, her rent from last year to this year, renting in Upper East Side of New York City is up 43% in 1 year, 43%. And that's not a shocker, that's what's happening out there. So landlords can move prices up when things are in their favor, and they're doing that. So that's an inflation hedge. Let's be clear about that. And secondly, the replacement cost of real estate is highly correlated to commodity prices because you need cement, you need steel, you need labor. All those inputs are dramatically increasing the cost of replacement. So those are reasons why people love real estate as an inflation hedge. And I'm not even talking about all the tax benefits connected with real estate, which is a session unto itself. And I think at another near-term time and place, we should do that. But there's so many exciting things about tax and minimizing your tax burden with real estate that I won't steal the show for that one. But I want to ask Jane a question because you mentioned to us New York is a place you're considering something. I don't know what you're allowed to share if the deal's been announced, but maybe you want to share with us what's attractive. First of all, your Sunbelt markets are the darlings right now. A lot of people are moving out of the Northeast and even California, moving to the Sunbelt that you're in now. So demand is coming your way, but yet you opportunistically said New York looks interesting today. So what was the reasons you basically looked at the Northeast here?
Sure, yeah. So we are, let's just say that actually this slides was Lee's slides, but it aligns perfectly with what you asked. So first I will address why we chose Sunbelt City. First, Sunbelt City, like the slices, the supply is low and demand is high. That's where the job is going. So people are moving to the Sunbelt City. So that's what supply and demand will determine is the price. It's our revenue. Is as Mark you just said, the rent is keep growing. So in the Sunbelt City, the rents are has been growing in the past 7, 8, 9, 10 years already. It's not just the last 2 years. Last 2 years, with all of those companies are moving from Northeast and the West to the Sunbelt City, the rents are, it's accelerated the process, and it's, the rents are just going very, very quickly. And also the asset price is coming, it's before pandemic, I would say there are a lot of developer and investor in the market already, but during the pandemic, we started seeing a lot of the big national fund and global fund are all coming to Sunbelt City, which at a scale never happened before. So the cap rate become very low in Sunbelt City, and which meaning the valuation of the property price going very high. Those are all driven by the fundamental of the supply and demand change. And then on the number 2 here, we talked about this, where the public and the private capital will flow. That's exactly what we talked about, all of those global funds all going there, and the lenders, the capital market. When I say we're following the money, it's because, we're watching on 3 things. One is our revenue, on the asset. Number 2 is on our cost side. Our cost side first is how much it will cost us to own the asset. Either is to build the asset or is to acquire an asset, which is the point number 3 on the slide. But also it's where the money is, where the lender wants to lend the money, where there are a lot of competition, deploying money. That's where we can get, cheaper money. So that's on the number 2. All of those public-private capital are flowing to those markets. So which gives, gives a lot of option for the project there. So the valuation, everything is going very high over there, and but because the fundamental is so strong, so even though people are buying at a very high price over there, it's still got a very compelling story in the future that can still make a very good return. So that's why the Sunbelt City is so such a great market. And the northeast part is really right now, if we look, if we're talking about the strategy, really on the northeast part is where we see those distressed assets or opportunistic project comes out, then we will evaluate those opportunities one by one. Yeah, just like you said, Mark, you said diversity is everything. As a portfolio, you have equity, you have, you have the inflation defended asset, you have all of those different things. And in the real estate, you actually have all the different sector. Those will have different behavior with a different economic cycle as well. So right now, what we're saying is the multifamily is continuing very strong, especially in the Sunbelt City. And the hospitality had a very tough 2 years, 2-3 years already. But another thing is the hospitality, because of those during pandemic, a lot of hotels actually has been shut down. A lot of hotels in New York City has been either converted to apartment or be debranded, all of that. So the supply of the hospitality for hotel rooms in some market has been decreased dramatically. And now, as the pandemic is almost at the end, the business travel start picking up back. So the demand for the hotel room are so high. So our hotel rooms right now we have so much pricing power for those products. So it's in general we know Sunbelt City is great, but now we're looking at New York City as some core location. Hospitality actually is a really good asset to look into, but again, it ties back to how much it will cost you to own the assets and operate the asset.
So
Jane?
Jane, you mentioned New York City, and that's not your go-to market.
Yeah.
How do you source good real estate deals?
So-
How do you find them, and what's your best source for local market intelligence?
I'll say that, of course, we source deals from brokers. We have off market, source, and we have peer developers, network, all of that. But I said that in the industry, it's a reputation. It's when you are in the industry long and you have all the network, people know you will perform. And if you if you say you're going to do a deal and you already have the track record, you will do the deal, people will start bring the deals to you. And two of my New York assets, actually the first one is an off-market deal coming from someone I never met. And that lady was actually I think it's on a ULI virtual conference. She heard one of my speech and all of that, and she did some research about me, and she knows somebody knows me. She sent that deal to my way. And the second deal is on my the first New York acquisition deal. I invited some other peers to participate the deal with me, and they know that that's a golden investment opportunity. And then on the second hotel, they actually secure this deal. And then they give our fund 50% allocation for us to invest. So it's a network and it's a reputation. And it's, of course, we work with brokers a lot as well.
Cool.
Yeah.
So Jane, when you were starting your real estate journey, who was the key influencer? Who told you that you really had an opportunity in real estate, and who was that person?
I would say my father. Yeah, my father is a commercial real estate developer in China. And I grew up in a family, my father is an entrepreneur. He is a problem solver. He has those can-do spirit. So I grew up with an environment, with, seeing him, have all of those attributes, really, really helped me a lot. And also, I said that before I become a real estate developer, I worked for Wachovia Securities and I worked for Bank of America Securities. And my underlying assets are all commercial real estate. And I joined the bank, I did my internship in 2005, but I officially joined the investment bank in 2007, July 2007. 1 month after, the first CDO default. And I've seen, so many interesting things going on. And me and another gentleman in the bank, we managed about $3 billion asset for the bank. And we managed some default portfolio for big insurance company. And we see all of those default assets. So before I learned what to do, and I learned what not to do first. So that's actually very important too. And then my father, again, he came to US in 2011, 2012. He encouraged me to start my own business. Yeah.
Well, I think that's absolutely wonderful. And before we go to the next page, next slide, which is just a high-level overview of your track record, I also wanted to mention that you are paying your your real estate experience forward because of your sponsoring of a scholarship to encourage especially more women to get involved in real estate. So I certainly applaud you for that. Let's quickly go to the next slide on the track record. It's kind of small, but Jane, can you take us through actually the first investment there, which is one that it looks like you've exited?
Sure, yeah. So this is a multifamily in Charlotte. And this project called Blue, and it's a 377 unit apartment. This asset is very interesting because we started construction in 2016. We finished in 2018. And we spent like about a half a year after completion to stabilize the asset. When we stabilized, we were offered at 1.8 return, investors return is about it's after deduct all the GP, all of those fees, everything. We built the asset at $53 million, and only 6 months after we completed, we've been offered $72 million to buy the asset. And then we, as GP, we didn't want to exit. Our LP needed the money, and they needed the money actually they wanted to invest in our next deal. And so, but they didn't come up with their equity raise. So they wanted to exit this deal so that they can fulfill their promise for our next deal. So we decided we agreed on the price. We bought them out. So their investors' return at the year 3 was 1.8 equity multiple. So year 3 is 1.8. And then some of the LP and us stayed in the deal, and we sold that 2 years later for 92, almost $93 million. And that was, so it was another 1.7 multiple, equity multiple. So you see that 2.99 over there. It's actually there. For this particular asset, we actually had 2 exits to it. Yeah.
That's wonderful. That's a great story. Talk a little bit about how you think about leverage on some of these deals. How much cash goes in and how much do you take on as debt?
Yeah, so when we are looking at the capital stack here, we're not only looking at the percentage, we're always looking at the cost as well. So if the cost is high, of course, we want to lower leverage. But if the cost is low, we can go a little bit of higher leverage. So we typically are looking at a 65% leverage. But at a high interest rate environment, we wanted to be mindful. We may decrease that to 50, 55, but always we will be looking at our revenue model. When we underwrite, we always underwrite the worst case scenario first, and so that we know at the worst case what we are going. Can we fulfill our debt obligation? Can we, at the worst case scenario, do I have enough cash to pay for tax, to pay for insurance, to pay for our lender? So if we can, then we underwrite that, then we know our worst case scenario. Then from there, then we will try to maximize our return on that. So on this sheet, you can see there is a project, La Sienna. That project is a project that's a project we actually, during pandemic, we saw there would be opportunity for some of those developer would not be able to come up their equity. So we see that there will be opportunity for us to acquire project, shovel-ready project. That is exactly what happened. It's in Texas. The deal was in Texas. The developer already had a hot loans sourced, but their equity falling off. They didn't come up with enough money. So we came in to become a co-developer with them, and we helped them to changed some of those design and how they are going to target their how they're going to operate, all of that, help them with them on some strategy, all of that, and then we secure the debt at 2.9% for 43 years.
Whoa.
And yeah, and then so that deal we actually had 85% leverage. And but at the cost that low, we're fine. And with that deal, I want to say that so we underwrite that deal with only $1,000 per unit, $1,000 per month per unit rents. And we actually just started to deliver units, and we're going to have each unit, we're going to have on average about like $350 more than what we underwrote. For a deal like that, it's like 35% higher than what we underwrite. And those are pretty much pure increase on the NOI, because our operating cost doesn't really change that much. And so it's purely goes to the NOI. And and also because of our interest rates were so low, so we will be able to get a low cap rate, which is a higher valuation on this deal. So that's a example for how we are thinking about leverage. And but some of the deal, I would say which one. And on some land deal, the Indian land we got because that's a long-term hold, everything. We actually don't have leverage on that one, and we purchased the land very low. It's showing like we purchased at $1.6 million. That's a 62-acre land right next to a very, very core location in Charlotte. The land, I bet if we put it on the market, we can get $7 or $8 million already. It's just we closed the land, I think July or September last year. So
Yeah.
But we didn't do any leverage on that because there would be no cash flow on that deal.
Yeah. It's your approach, your thinking. You can see opportunity where many other people can't. So congratulations to you for all your success. And
thanks, Lily. That's very kind.
I'm going to move forward to the next slide just to wrap this up because we're actually a minute over. Just some takeaways with regard to real estate investing. There are so many niche factors and nuances that influence real estate performance, as you've just heard Jane very eloquently mention. You need to use trusted real estate advisors, and you need to know where their expertise is, because as you can see, real estate is a broad category. Which sectors do they focus in? Which markets are their sweet spots? What kind of track record do they have? Have they been through a couple of economic cycles and understand the impact of interest rate and inflation? And then finally, please ask if you don't understand a concept or a term. Ask for clarification, even if you think you know the answer. Sometimes the answer you get in response is very unexpected. And then finally, just to wrap it up, if real estate is a good inflation hedge, the answer is it depends. And with that, I'm going to hand it back to Mark, who's going to offer some time if anybody wants to do one-on-ones. Mark, do you want to wrap it up?
You basically did it for me, but I'll just finish the sentence you started with. In the past, we've had speakers, I won't say as charismatic and talented as ones on this podcast, but people have asked me, can we have one-on-ones, or could we have a dinner or a drink, whatever, with the speakers? So I think that's a terrific idea. We're willing to do that. And I know in the case of Jane, she's in Charlotte most of the time. Fortunately, she will be in New York, not next week, but the following week. So if people would like to have a meal with Jane, I could certainly schedule a small group for dinner, again, the week after next. So just be kind enough to reach out to me or Nadia via our email, and we can make something happen on the one-on-one dinner front. I think it'd be a terrific opportunity to not only get to know Jane and Lee better, but to really dig into things that we just touched on at a very high level on this presentation. But that's really all I wanted to share with you. And again, thank you so much, Jane and Lee, for doing an awesome job. And thank you, everyone, for participating on this event. And we look forward to seeing you on our next podcast a week from today. So thank you very much.
Thank you, everyone. It's an honor to be with you all on the online today. Thank you, Mark. Thank you, Lee. Thank you, Nadia. Thank you, everyone. Thank you, John, for all of your questions.
Yes, thank you. And go, Jane.
All right, thanks, Lee. All right, have a good one.